Good morning, traders and investors. Welcome back. My name is Roger Scott, and I'm the Senior Strategist for WealthPress. And this is my morning video. I do these every day. I'm finally back in my home after my trip to DC. It's August 10th. This is the last trip I have planned till I think January or February. I ain't going anywhere. It's about 7:55. Market's going to open up in about an hour and 35 minutes. Now, I was hoping to do this a little later, but I'm not going to have an opportunity. The market is up a little higher. Now, today is going to be a very important day. Matter of fact, let me just take you to the stock market and show you something to show you why today is so important. So right now, what you're looking at is you're looking at a picture of the Dow Jones. And the last time the report that's coming out today is coming out, which was the CPI, not the last time, the time before the last time. Last time it was 9.1. The time before it was 8.6. This is what happened to the stock market. 1, 2, 3, 4, 5, 6, 7 days, we went to new lows. That's when we found out that inflation is getting out of hand. Now the question is going to be, has it peaked at 9.1, or is it going higher, or is it going lower? And is the core CPI going to move higher or lower? And the core CPI is when you take away the food and energy, and that's what the Fed looks at. Now, the expectations, and we'll go through this right now, but the expectations is for the core to be higher and for the headline number to be lower, which doesn't make much sense to me because we know that energy and food prices have gone down substantially in the last couple of months. So both numbers should be lower. But this is what the expectation is. They're looking for the CPI, the headline, to go lower, which means inflation would have peaked, but not really if the X and food and energy number goes higher. What I would really like to see, what I would really love to see, is this number also lower. This number at 5.9 or 5.8, that would confirm that we in fact did peak out. And if inflation peaked out already, then that can cause, now we still have an inflationary pressure, but if recession worries have overcome already, and if the worst is behind us, then the market can have a really good period. If inflationary pressure is really bad, then we know that the Fed is going to take a lot more aggressive action, and now they can because employment data was so darn positive last week. So the expectation for the ex-food and energy is 6.1. I'm hoping this number is a little lower. I'm hoping we peaked. And the CPI year over year is expecting to go lower. So the headline will be inflation peaked, but this is the number that really drives everything. So pay attention to the CPI. Don't worry about month over month. This means nothing. Year over year, we're looking at X food and energy and with food and energy, 8.7, 6.1, hoping that this number is in fact lower. Let's talk a little bit about the economy, and I'll kind of regurgitate what I just said in different words here because this is a big topic, and this report's coming out in about 32 minutes, and I'm hoping to have this to you before the report comes out. European stock market opened higher while Asia fell Wednesday ahead of the release of U.S. inflation data that traders worry will show upwards pressure on price. Still is too strong for Federal Reserve to ease off interest rates. Data on Wednesday, that's today, is expected to show headline U.S. inflation in July eased. That's the headline. That's this number right here. That's this number they're talking about. Kind of want to do a little show and tell. From the previous month's 4-decade high, but survey found traders expect core inflation, that's the other number, which strips out volatile food and energy, leaving rent and other costs to edge higher. That is despite other data that showed economy activity cooling. So I'm thinking both numbers will be low, but anything above 8% is too high. It's true. The Fed raised rates 4 times this year, twice, 75 points, triple its usual margin, and they're probably going to do the exact same thing in September, or maybe even go down up to $1 because we have stronger employment and the markets can handle it, especially with the bond market not going down, not just brushing this off. And I'll go through that in a minute too. Federal officials acknowledge there's danger the U.S. economy might tip into a recession, but some point on the strong job market, including myself, as evidence it can tolerate more rate hikes. 100% true, especially with the employment numbers picking up. Markets have been rattled by the war in Ukraine, spike in oil prices, wheat, commodities, uncertainty about China, COVID restrictions, and just about everything else. We're still dealing with the first COVID outbreak, supply and demand issues. Now, looking at the bond market, the broad bond market, The bond market is a little bit higher, but it's not going to do much till after the report comes out. So if the number is watch the bond market. If this goes higher, it's bullish for stocks. If this goes down, it's bearish for stocks. If this goes down, that means the numbers are set to cause interest rates to go up again. If they go up, that means status quo, and we actually have an order to sell bonds right about the 120.70 level, I think, somewhere in that ballpark, 120-ish level to sell bonds. So I'm hoping we will get hit here, but we will see. It'll be a very, very interesting day in the market, and I can't wait to see how the market reacts. Now, on Thursday, we have jobless claims, which will be very interesting in light of the data we had last week, and PPI. The PPI will be very important, but I don't want to go over. I don't want to go too much too fast. Now, looking at the sectors, looking at individual sectors, financials are still looking pretty good. Utilities are looking pretty good. Consumer staples are still choppy. They haven't gotten away, and they're still above that level, that hump, that 8.6 hump I keep talking about. So is utilities. Energy is not. But I'm hoping if we're not going into a recession and things have peaked out, energy might actually rally because we're still have inflationary pressure. Healthcare, look at that, choppy, just like consumer staples. Choppy, choppy, choppy. Technology, I think, is going to cool off. I will be very surprised if it stays up here. Don't really have a feel for industrial right now at all. I like real estate right now, and I think if inflationary pressure, I think one of the things about inflationary pressure, it's not scaring real estate away too much because interest rates will get higher, which are actually beneficial for real estate. Communication sector is going to go down, I believe, and consumer discretionary, communication services, and tech are going to be hurt the most by today's data because we're going to hear again more evidence of a rate of inflationary pressure versus the worst is behind us, I believe. But keep your eye on consumer staples, keep your eye on utilities, keep your eye on energy. Most importantly, keep your eye on the tech-heavy stocks. If the number's good, they'll rally. If the number's bad, they'll go down along with the bond market. But I've got even more stuff for you today. It's Wednesday. Today, I want to give you two hot stocks. So, you know I like consumer staples, right? I like Monster Beverage. I think Monster Beverage has gone too much too fast. All the way from 99 to 87, too much. RSI is hitting it. I think this is way, way too much too fast. So I think we're going to go into this later today. I like this quite a lot. And Match, I wouldn't be matching anybody on Match. I mean, look at this trend. Look at that. It went up a little bit. It went from 59 all the way to 72, and I think it's going to be coming down more. I know it's near the lows, but that's what you want. You want to sell stocks near the lows. But I believe Match is going to go down, and I believe Monster Beverages is going to go up. And I'm actually going to go long Monster Beverages if I can get a good price today. Probably, most likely. But I'll keep you posted on that as the day goes on. Folks, I've got something really exciting for you today. Really exciting for you today. I'm sharing the details of a brand new project that's allowed traders to build their own ETFs. The fundamentals of what I'm uncovering today are used in the majority of systems that I built. And you're invited to come absolutely free if you click the link below to register. You've got to take action. It's not going to come to you without you asking for it. Here's a quick breakdown of the lunch menu of what I'm covering. I call it the agenda, the lunch menu, whatever you want to call it. How to custom build your own ETF. Core factors behind what I call front-runner stocks. You're going to love this. The stock selection process, portfolio management tips, plus my number one front-runner stock to finish 2022 strong. And I've got a surprise for you in the end, and it's not what you think. I'm also going to give away a couple of stocks. Sign up using the link below for an invite, and I hope to see you at 1 p.m. Eastern Time. Follow the link below. You're going to love it. You're going to love this. It'll blow your mind away. You're going to love this, and I got a surprise for you and two hot stocks. If you wait till the end, it's going to be a great class. You don't want to miss out. Follow the link below. Check out Front Runners right now. Bye, guys. You have a great, great day. Love letters, emails, comments, support@marketgeeks.com. Be careful out there, and I'll give you an update on Telegram after this report comes out. Bye, guys. See you later.